Exercise 1-29. We're going to use the accounting equation to analyze business transactions. So why would a company want to analyze business transactions? Well, they need to keep track. How much cash do we have? How much accounts receivable do we have? How much accounts payable we have? Accounts payable, remember, is a liability. How much equity do we have? How much expenses we have, etc. All right, Samantha Stanford opened a medical practice. During July, the first month of operation, the business, titled Samantha Stanford, medical doctor, experienced the following events. So we click on here to open the transactions. So here are some transactions. So what we're supposed to do is we're supposed to take these transactions one at a time and input them into our accounting grid. So if you read through here, I would just give you some highlights. Abbreviations used, AP. So this AP here stands for accounts payable. So remember, that's a type of liability. Accounts payable are amounts due usually within the next 30 days. CAP. CAP stands for capital. So capital is in a sole proprietor. Remember, sole proprietorship is where there's only one owner, like this business here. So Samantha is the sole proprietor. In a sole proprietor, the main equity account is called capital. The other accounts that fall under this equity classification, notice all of these accounts fall under the equity classification, but only capital is the true equity account. These accounts just affect equity. So let's talk about this one. This WITHDR stands for withdrawals. So do you remember how withdrawals affect equity? Let's go back to our screenshot from the video. Owner withdrawals over here decrease capital. So that is why withdrawals have a minus in front of it. Now this REV stands for revenue, service revenue. So we'll use this box whenever we sell a service. So how do revenues affect equity? Remember, they increase, this is the increase column, they increase equity. So that is why the revenue has a plus in front of it. And how do this EXP, these three here, stand for expenses? SAL stands for salary expense. How do we know that? It tells us all these abbreviations up here if we read them. So these EXPs, how do expenses affect equity? Well, remember, they decrease equity. So that's why expenses, which is just right here, here's expenses. Expenses, remember, just the cost of doing business, so the cost of selling goods or services. So expenses decrease equity. That's why all of these expenses have a negative in front of them, a minus, because they are going to lower equity. All right, now we can start analyzing these transactions. So the first transaction we have is July 6th. Stanford contributed $65,000 in the business by opening a bank account in the name of S. Stanford, medical doctor. The business gave capital to Stanford. All right, so remember the 3 steps to analyzing transactions. We're going to do this a lot, so after a while this will get pretty easy. But at first it's new to us, so it may seem a little strange. The 3 steps from our slides, from our PowerPoint and the video. The first step is to identify the accounts that are affected by the transaction and the account type. Then we're going to decide, are these accounts going up or down? Like, is cash going up? Did we receive cash, or is cash going down? Did we pay cash? And then we will determine if the equation balances afterwards, because the accounting equation always has to balance. So on July 6th, the owner contributed $65,000 cash, so we know cash is affected. And the explanation says the business gave capital to Stanford. So really what's going on is she has made an owner contribution. And how do owner contributions, by the way, affect equity? They increase it. So whenever there's an owner contribution, that contribution goes directly into the capital account. Because why do we know it goes in one of these equity accounts? Because remember, owner contributions affect equity, okay? And by definition, owner contribution is not a revenue. It's not a draw, also known as withdrawal. It's not an expense. So we're going to have to put the owner contributions directly into the capital account. So we know capital is affected. We know cash is affected. So let's start with cash. So the next step, remember, decide if each account increases or decreases. So when the owner contributes $65,000 for the business to start the business, does the business have more cash or less cash? Well, we have more, so we're going to put a positive $65,000 here. Now, capital. How is capital affected? Is capital going up or is capital going down? Well, remember, an owner contribution increases capital. So we have to leave this as a positive $65,000. The other reason you know that this had to be a positive $65,000 is because this transaction row right here has to balance. And when I say balance, when it has to balance, it means the accounting equation must balance. So for example, here's our equal sign. So how did we affect the left side of the accounting equation? We made it go up 65,000. Therefore, if we're going to affect capital, which is on the other side of the equal sign, then to make this transaction balance, we have to put a positive 65,000 on this side. So now I can check my answer. Oh, one thing, notice when we read the instructions here, it tells us, let's see, where is it? Complete only the necessary answer boxes for your transaction lines. So this line or row with a date on it, 7/6, this is the transaction. So on the transaction rows, only put in numbers for accounts that were affected. In other words, don't put a 0 in here. If I did, my accounting lab would say I'm wrong, which is kind of lame because it would still balance if I put zeros in all those other ones. So just remember, don't put a 0 in there. Good. So the transaction is correct. So let's go to the next transaction. We are now on 7/9. So let's see what happened on 7/9. Paid $52,000 for cash. So when they say paid, that means the company paid. So if the company is paying cash for land, what are the two accounts that are affected? Obviously, cash and land. Now let's figure out which direction are these accounts going. Let's start with cash because it's the easiest to analyze. It says we paid cash. So if we paid cash, that means cash must be going down. So we have to put that as a negative $52,000. All right. Now, why did we pay the cash? Well, because we're getting land. So our land account, does it go up? Do we have more land? And therefore, we should put a positive in there? Or do we have less land? We have more land, so we have to put positive 52,000 in there. Now let's double check. Does this transaction row, remember that's this row with a date on it, does this balance? In other words, is the accounting equation balanced after this transaction? So let's look at it. On the right side of the transaction, we have nothing. We have 0. So there's 0 on the right side. What do we have on the left side? We have positive 52,000 minus 52,000, which is a net 0. So yes, this transaction line does balance. Now, this BAL stands for balance. So in other words, we're supposed to calculate, well, how much cash do we have? The way we do that is we look at our previous balance of cash, 65,000, and since cash is going to go down, we have to subtract that. So 65,000 minus 52,000 gives us a positive $13,000 of cash. Now let's look at land. We had 0 land. We have more land, 52,000. So obviously our new balance is 52,000. And capital. We had 65,000. We did not affect it, so we still have 65,000. Now note, according to our instructions, it says carry down all balances to the BAL balance line, including zero balances, entering 0 for any zero balances. So on the balance row, we do enter zeros for a zero balance. How do I know this is a zero balance? We had 0 plus 0, 0 plus 0. So we have no withdrawals yet, no revenue, no expense, no expense, no expense. Check our answer. What I should have done, which I forgot to do, is I should have, remember the third step is determine if the equation balances. So what I should have done before I clicked on check answers, I should have checked, does 13,000 plus 52,000 equal 65,000? And it does. So we have to make sure that the balance row balances and that the transaction row balances. Now we are on 712. 712, purchase medical supplies for $1,600 on account. So let's talk about what this buying something on account means. So, and here's my note on this. So if we purchase something on account, that means we are promising to pay for it later. So we have to increase accounts payable, which is a liability. So we have to show that we owe money. Now, a real life example might be, let's say you build homes and you call Home Depot and say, I need some lumber at my site. Can you please come and deliver it? And instead of paying for it then, you say, just put it on my account. So that means we are purchasing something on account. So therefore, we have to increase our accounts payable. So in this case, we purchase medical supplies on account. So we already said since we're buying it on account, accounts payable is affected. Remember, that's what this AP stands for, according to our instructions, stands for accounts payable. So what else are we getting? What's the other account that's affected? Medical supplies. That's what MEDSUP stands for, medical supplies. Again, all the abbreviations are explained up here. So we have more medical supplies since we purchased them. So our medical supply account is going up. So we have $1,600 of medical supplies. Since we have more of it, I'm leaving it as a positive. Now let's talk about accounts payable, which is a liability or a debt. Do we have more debt now that we purchased that or less? We have more debt, so we have to put that as a positive. So again, we have to check, does this transaction row balance? Well, on the left side of the accounting equation, we have 0 plus 1,600 plus 0. So we got 1,600 on the left side, and we have 1,600 on the right side, so it balances. Now, we have to figure out our new balances. So to calculate my cash account, I'm going to take the 13,000, which is the previous balance, plus 0 gives me 13,000. The new balance of medical supplies, I had 0. I'm going to add 1,600, gives me 1,600. Land, I had 52,000. I did not buy any more. Still have $52,000 of land. AP had 0, bought 1,600, or excuse me, not bought. I had 0 debt. I have $1,600 more debt because I bought it on account. So I have $1,600 of AP. And capital, I had 65,000 plus 0. Notice I just copied and pasted that. And then all these are going to be zeros. 0, 0, 0, 0, 0. And now what I should do is I should double check. Do these three, 52,000, 1,600, and 13,000, equal what's on the right side of the accounting equation? 1,600 plus 65,000. And yes, they do. All right, 7:15. Let's see what happened on 7:15. Officially opened for business. So in our accounting records, according to this, are any of our accounts affected? We officially opened for business, but are there any dollar amounts for any of the accounts? So no. So there's no transaction that we need to record here. So remember, you only record a business transaction when it affects counts and we can reliably figure out what the dollar amount is. No accounts and no dollar amounts were affected on the 15th. So on the 15th, I'm not going to put anything in the transaction row, and then I'm just going to bring down my balances. I'm going to get this out of the way because it's bugging me. So my balances are still the same. Let me just copy and paste. Double click there, paste. Zero. I'm not going to hit my tab on the keyboard. It takes me to the next field. 0, 0, 0, 0. There we go. So the authors are trying to trick you. There was no transaction on the 15th, so you don't record anything. Let's get back to my transactions. I'm now on the 20th. We paid cash expenses. So we have some expenses. We got employee salaries, office rent, and utilities, and we paid them all at once. So let's obviously cash is involved since it said we paid cash, so cash is going to go down, and employee salary. So let's start with employee salaries, $1,500. So where's employee salaries? So that's salary expense. Already forgot the number. Employee salaries was $1,500. And then I think we have rent expense, right? Let's back up. So what do I need to put here? Is this going to be a positive or a negative? Now remember, expenses, let's bring this back. Expenses lower, they decrease equity. So that's always going to be a negative. But notice the negative is there for us already. So don't put another negative because a negative and a negative would be a positive. So all these expenses, whenever we have them, will be it already has a negative in there, so leave it as $1,500 in the box. Now we've got rent expense. Office rent of $1,300. And we've got utilities of $350. And I think this last column, yep, utilities expense. So now obviously this transaction line does not balance because we have a whole bunch of transactions or a whole bunch of numbers affecting it on the right side, but nothing affecting it on the left side, which is those three accounts. So remember, we paid cash. So what we're going to do is how much cash do we pay total? $1,500 plus $1,300 is $2,800 plus $350 gives us what? $3,150. So since cash was paid, cash is going down. We have less cash, $3,150. Now double check. Does this transaction line balance? On the left side, these three boxes, we got minus $350. And then on the right side of the equation, in these boxes, what do we have? We have minus $1,500, minus, here's a minus right there. It's not, there you go. Minus $1,300, and then minus $350. So that balances. Now we have to calculate our balances. So we had $13,000 cash. We subtract $3,150, and that gives us $9,850. We had 1,600 medical supplies. We did not affect it, so we still have 1,600. So we can bring down the land. Still have 52,000 land. We still have debt, accounts payable, of 1,600. We still have capital of 65,000. We still have 0 withdrawals. We still have 0 revenue. Boy, this business is not doing well. We've not sold anything. And then we've got 1,500, 1,300, and 350. How did I calculate these totals? I took the last balance and added the new number. Oops, I forgot. What I should have done is I should have double checked that these three numbers are equal to these numbers, and they are. If they do not balance, then I've done something wrong. I have to go double check my numbers. So now we are on July 31st. We earned service revenue for the month, $8,000 receiving cash. So we sold some service, and since it's a medical doctor, she must have seen some patients. So she sold $8,000 of services, and they were paid in cash. So we know revenue, which is what this REV stands for up here, this service revenue is being affected. And we know we have more cash. So cash is going up. So I'm going to put positive 8,000 under cash. And since we sold something, our services, we have to record service revenue. And service revenue is also going to be a positive because revenue is always going to be increasing. Let me close this so you can see. Revenue always increases equity. Again, how do we know that? From our familiar screenshot. Revenues increase equity. So then we have to double check. Do we have positive? Oh, I should say we have positive 8,000 on the left side of the transaction. We have positive $8,000 on the right side of the accounting equation. So this transaction line balances. Now we need to calculate our new balances. So 9850 plus 8,000 gives us 17,850. We still have $1,600 of supplies. 52,000, 1,600, 65,000, 0. We finally have some revenue. We still have some expenses. And remember, to get these balances, I'm just finding the last balance and adding the new entry, which in this case was 0. Then we're going to double check that this plus this plus this on the left side equals this. And this time I'm going to actually do that. So here's our calculator. So on the left side, we've got 17,850 plus 1,600 plus 52,000. So 71,450. So I need to remember that number, 71,450. And we write that down, 71,450. All right. Now on the right side of the accounting equation, we need to add these up, and it should be the same number. So we got positive 1,600 plus 65,000 plus 8,000 minus 1,500 minus 1,300 minus 350, and that gives us the same as 71,450. So our this balance line does balance. And lastly, we've got our last transaction, which was paid $800 on account. So let's talk about what paying on account means. If we are paying on account, then that means we are paying down our accounts payable, meaning we're paying off some of our debt. You could also say we're paying off some of our accounts payable. So accounts payable is going down because we're paying off some of it or all of it. So let's see, we're paying off $800 on account. So our AP, let's see which column that is. This column is AP. So since our accounts payable are being paid off, some of them, we have to put it as a negative. And since it says paid $800, that means we paid cash. So I have to put down as minus $800 cash. And then finally, let's check this transaction line, make sure it balances. So we got minus 800 on this side of the accounting equation, minus 800 on this side. We're good. And then we have to calculate our new balance. So 17,850 minus 800 gives us 17,000. I'll put the 0 in there so it's or comma, so it's easier to read. We've got $1,600 of medical supplies. We've got $52,000 of land. We've got $800 of accounts payable, and I got that by taking the 1,600 subtracting 800. We get 65,000. 0, 8,000, 1,500, 1,300. Close this so we can see what we're doing. 350. And then I would double check that these three numbers right here, add those up and make sure that they equal these numbers here added up. And they do. So that problem took a while because I had to do a lot of explaining and talking. But once you get practice with these, they get pretty quick. So don't forget to do the other one with the random numbers.